Hi, and welcome to this next edition in our series on arbitrage and Bitcoin trading bots and all that fun stuff. My name is Jared. I am the Chief Liquidity Officer of CoinDex Labs. In CoinDex Labs, who are we and how can you try our 5-day free trial on our market maker? Well, you can view this YouTube video down here to see that in action. And while the market maker is actually on pause right now, or at least the free trial is, that's because we've been redesigning the bot to be more beneficial for our users and less risk averse. So if you take a look at our live chart here on chart.coindexlabs.com, you can see the bot is live with a balance, and you can see that it's actually done fairly well in this dump. So the blue line here is the Bitcoin to US dollar price, and it dumped significantly, and we gained a whole bunch of Bitcoin value and a whole bunch of US dollar value on our returns, and we're currently at about 12% Bitcoin over the last couple days and 4% on the US dollar. So once this is all back up and ready and ready to deliver, we'll reinitiate our 5-day trial, and you can have a look at our other video to see how that works. So today what we're looking at is the challenges of executing arbitrage opportunities in algorithmic trading. And for instance, we're going to take a look specifically at three-way arbitrage crypto trading opportunities on Binance, on their spot markets. So what does that look like? What is three-way arbitrage? What is three-way arbitrage? Well, let's say I have an asset. Let's say I have an asset on Binance, and let's take a look at Binance to take a look at what this looks like. We'll take a look at the markets. Let's take a look at the US dollar tether markets. So let's say I had some US dollar tether. I wanted to sell that US dollar tether for BNB, and then I wanted to use that BNB to buy Bitcoin Cash, and then I wanted to sell that Bitcoin Cash back for Tether. Let's say I could do that and find a profitable opportunity among all of these markets, and there's hundreds of markets on this exchange. So we have an asset, trade it for second asset, trade it for a third asset, and then back to original asset. And that's why we call it three-way arbitrage, because we have two trades, and then we have three trades, and then we have back to the original asset. So if there's fees involved, let's take a look at what the Binance fees are for their bottom tier, because they have tiered fees. As you get more volume, hold more of their exchange token, you get less fees. But for the bottom fee, it's 0.075% or 7. Yeah, and then if you hold the BNB token and pay the fee in the BNB token instead of paying it in whatever token or coin you're trading, it's 0.6% from the maker or the taker. And we're only concerned with taker fees because we're looking at initiating the trades in each of these cases against whatever's on the books, so we can act on the opportunities that exist. So if it's 0.06%, then we have one trade at 0.06%. We have two trades at 0.06% again. And then we have three trades at 0.06%. And then we have back to the original asset at 0.06%. What this looks like is 4 times 0.06%. What is that? That's 24%. 0.024%, which is actually a huge amount of fees. And we can take a look what this looks like with a freeware bot that I found on the internet. And this guy has a donation link if you want to take a look at reimbursing them for the information that they provided us. But if we do site github.com Binance triangular arbitrage, we can find this this bot. So here he is here, and you can actually use this bot to automatically trade these opportunities. Let's say you negotiated lower fees, or you managed to trade a lot of volume and held some BNB and got lower fees. This might actually be advantageous to you, but I've set this up already on one of my virtual machines, and let's take a look at what that looks like. So here we are. Let's open up that config file. Here's our market maker, but what I want to do is look for Binance Triangular Arbitrage in the config file. Open up the config file. Let's change our taker fee to 0%. Let's see what kind of opportunities we can find at 0%. So actually I already had it running. Let's run it again. What coin are we looking at here? So we're holding US dollar tether to begin with. And we're going to trade US dollar tether for other financial instruments and other financial instruments again. So again, the point of this video was the challenges of executing arbitrage opportunities in algorithmic trading. So another problem that we might face is how long does it take to do all of these trades? Because let's say we bought our first asset. Let's say the opportunity exists at 0.1% for all of these items. If it takes me 100 milliseconds, and I notice I can't have these in here. Let's say it takes me 100 milliseconds per trade. Let's say I trade for the first asset, 100 milliseconds. Trade for second asset, I should say second. Trade for third, 200 milliseconds total. Let's say that after I complete these trades, then the trade for the third asset back to the original asset is no longer at the arbitrage opportunity that we found. So let's say that we get less of our original asset back than we had originally planned. Then because it takes us 300 milliseconds to do all of this, the opportunity might disappear. So I mean, let's say let's say we have $1 of our asset. We're going to trade for the second asset and get $1.01. Trade for a third asset and get half of that back, and trade for our first asset back and get a little bit less than that back. Let's say this was the opportunity that we had. So what we might find is that any of these legs of the trade might actually disappear in the time it takes to complete all of these legs of the trade. And we just call that the execution challenge. The execution time challenge. And we could actually take a look at what that looks like here in our freeware Binance Triangular Arbitrage trading bot that we found. So again, we have 0% fees here, and we're actually finding that there are no profitable trades available for 0% fees on the US Tether whole base asset. But you can see here the ABH, that's the first trade, the second trade, and the third trade are changing all of the time, which means that these things exist for less than a second usually before they disappear. And you can see that changing in real time. But if I was to change these fees again and make them 0.06%, which is what most people will pay if they just start this off with the traditional fees, we'll run that again. What did I just break? It's this one that I want. We'll see that our negative 0.1% arbitrage opportunities that we found are no longer that attractive when we run with 0.06% taker fees, which is our second challenge in executing these arbitrage opportunities, is what happens if I have to pay more fees than what is ideal. And we will find that out shortly. So again, if the arbitrage opportunity exists and then you execute one or two of these trades, and actually I have a freeware GitHub repository that failed recently because of this exact reason. Basically, it would find an arbitrage opportunity, and then because it was on-chain, or rather it was using the Ethereum blockchain to execute these arbitrage opportunities, we'd find that after one block or two blocks to execute on those opportunities, that we are no longer able to find a profitable trade, and then we're actually left holding one of it would be left holding one of these intermediary assets, as the ARB opportunity didn't last long enough. Alright, let's go back to our Binance Trader that we found on GitHub, and now you see that these opportunities that it's finding are much less profitable. They're actually less profitable by, as you'd imagine, a magnitude of 0.06% times 4, which is 0.024%, because we're now paying fees on each of those legs. And that's basically what most arbitrage opportunities face as issues when we're trying to execute on them, is this age limit here, and then also the fees that we have to pay. Alrighty, thank you.